Maverick traders. Welcome out to your market roundup August 5th. Corey here with you, and boy, do we have a lot to talk about. Quite a wild day in the market. Let's get to it. So, we're always going to highlight what's happening in the broad markets, and today we had an unwind of yen carry. We had an implosion in stocks. Down 4 and 5 and 6%, broad markets down multiple percentage points, and the volatility index exploding higher. We're going to talk about what that did for sectors and then highlight our very best ideas.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's break down what happened today.
So what a wild day in the markets. As we look at broad equities, a lot of damage was done. Of course, Dow down 2.5, S&P down 3, NASDAQ down 3.5, Russell down 3, oil flat, gold down 1%, crypto markets, if you follow them, down 10, 15, 20% across that space. So just widespread selling. So what was the cause of this? Well, the big news event is really the yen carry trade. This is coming undone. It's imploding. It's basically people shorting the yen and using that as the funding source and then buying assets on the other side of that. Well, the flip side of that is as the yen has been exploding higher, they've had to cover the yen, losing on their shorts, and then go sell the risk assets. And that's what's driving down equities and moving the Japanese markets, moving bonds, moving all sorts of things. And certainly somebody somewhere is imploding, and we're going to hear the story. Maybe they'll write books about it. I don't know, but somebody out there has massive losses, and probably there's now contact between central banks and discussions about how bad this is and what the type of contagion is and so on and so forth. So this is very real. How real is it? The VIX had its third largest spike in the past 25 years. The only time the VIX has been higher in the past 25 years is 2020 in March during COVID, and 2008 in the global financial crisis. So are markets concerned? You bet they are. Advanced decline line, widespread selling. 90% of stocks down today. The 50-day moving average, now 70% of stocks are below it. So as we look at the charts of the equity markets, I talked about this last week and made perhaps my greatest of all trading calls. I don't know. I talked about how the markets would probably try to sell off, but then they would bounce further and probably into this gap zone, and that would be a perfect spot to short. You can go back and watch last week's video, but I just had this market spot on. It kind of did the little fake out, saw a little jump up on the Fed meeting, and then the implosion to the downside. Now, this part of it I certainly wouldn't have predicted. I wouldn't have said, and then from there will fall precipitously by, 10, 15% in 3 days or whatever. That's not something that I would have predicted, that we would have this much deterioration, this 10% type of decline. Having said that, I'm not surprised we're going down to these prices, and don't be surprised if there's more selling to come overall. The NASDAQ, really picturesque. We talked about this, how it could come up underneath those moving averages. Technically, this was just perfect price action, kind of that choppy behavior back up, and then away we went. Now, a lot of people are going to blame the Fed, and they're going to say because the Fed didn't cut rates, that caused all of this. And that's just not reality, okay? Do I really think, and do you really think, that because the Fed didn't cut by 25 basis points on Wednesday, the whole economy come undone and the markets collapse and nobody has confidence? That's not reality. Now, I'm not a Fed cheerleader necessarily, but I don't think because they did or did not cut, it was really going to change much. If they had cut, would it have change things a little bit? Well, maybe. Do I think the markets would have still gone down and that this downtrend was still going to come, whether they cut or not? Sure. So whether they cut in September or have done it in July, the bigger concern would be an emergency rate cut. I hate that the Fed would react in a manner where they panic. I do not want to see panic, fear, greed, envy. I don't want to see any of those emotions out of any traders, certainly not the Federal Reserve, which is in charge of making huge decisions. So I think if they panic and do an emergency rate cut, of course, the markets will probably bounce up initially, but it's just another opportunity to sell. Look, rate cuts are coming. Whether they come in July or September is not going to make or break the entire world. That's not reality. This is selling off due to the yen carry. Could it be, influenced by the Fed? Of course. Could it be impacted and maybe a little bit worse because they didn't? Yeah, I could go for that. But I think realistically, again, we were going to sell off. Now, if we look at the yen movement, I mean, think about the yen up a couple of percent today. If you were to look at the yen versus the US dollar on an annualized basis, its volatility might be 8% for the entire year. So when we're talking about the yen, these don't look like that much, but that type of move where you're going from 57 to 64, to put that into perspective, you think about that 7 point advance from 57, that's 12%, but it happened in 2 weeks. I mean, that's more than an annualized amount of volatility, and it happened in such a short time span. And this is where markets get rattled. It's the speed and velocity of things that can be a huge problem, that can create massive ramifications and send tremors kind of through the markets and create some risk of contagion. So, do I think that the Japanese central banks and these other central banks, again, are trying to figure out where the pain is and who's blowing up, who has a short yen trade, and currency trades are highly leveraged? Whose funds, who's blowing up, and how much risk does that have to other financial institutions and so on? They're doing their homework. They're in meetings. There's no question the Fed had some sort of emergency meeting today with discussions about all these happenings. Now, what comes of that is debatable, but there's a lot of risk out there, and people need to be aware of how much risk there is. Again, the VIX at one point was up in the 60s. We haven't seen a VIX at that number except for back to 2020 and COVID and back to 2008 and the global financial crisis. Now, do I think the VIX was a little overdone today given we're not in a stock market? The stock market's only back to where we were in April. We're not crashing in the stock market like we did in these two periods. So it's really odd behavior. The VIX is kind of overdoing it compared to how much deterioration there has been in stocks. I mean, stocks are back to where we were a couple of months ago. In 2020 and 2008, stocks were collapsing, cascading lower. But having said that, a VIX at this number, just understand what that means. This suggests that the stock market is going to be moving a couple of percent every day. That's what this type of pricing in the VIX suggests. So is there more volatility coming? The idea that this is the end and it just all calms down from here, perhaps. But even if it's going to calm down, and even if this was like the earthquake, well, there's still going to be some aftershocks, right? And you're still going to have daily moves in the 2% range. Do I think stocks will move 2% up or down or something like that tomorrow? Yeah, probably so. We're going to be dealing with this for a little while. So the anticipation for everyone should be that volatility is here to stay for now. And when the VIX is in one of these runs, you just need to throw out logic and you need to say, anything is possible right here. So if you're holding a position and it's gone bad and you're just hoping that you can get out of it and hoping that you can dodge the bullets and so on, why bother? If you really believe in yourself and as a trader, why would you put yourself in a situation where you have to dodge all these bullets right now and all this risk that's coming? Why not live to fight another day? If we really believe in ourselves, then we want to stay in the markets. And if you've had success for an extended period of time, why give it all back during this type of period? Now, the good news, of course, is, well, we can change, we can be bearish, we can limit our risk with spreads, we can do all those sorts of things. But I just really hope that nobody's in a situation where a lot of volatility can destroy all that they've worked for. That is not a place that you should be. That is not a place that will last. If you put yourself in that situation, look, eventually the market will get you. So don't do it. Don't put yourself in a situation where any market environment can completely destroy everything you've worked for and all of your future prospects as a trader. Make sure you manage risk, you cut losses, you do whatever it takes to get through this period. Not just thrive, but make sure you survive, right? That's the first rule. Survive first, then we'll try to thrive second. But first rule is that no matter what the market does, it's not going to mortally wound me where I can't, where everything I've worked for the last few years or something would be given back. No way, no how. Now, as we look at equities, there's not a lot of green out there, of course, it's just widespread selling, but I want to point out the brightest red is in the largest of large cap tech names, the big seven names, Amazon and Google and Apple and Microsoft and Nvidia. They were just getting absolutely hammered. That's an area where I think there's been a lot of leverage, and it's interesting because if you overlay a chart of the NASDAQ and the Japanese yen, when the Japanese yen is spiking up, the NASDAQ is spiking down and vice versa. So the more this is coming unwound and the more those forced liquidations and things play out, look, there's a lot of leverage in the Japanese yen trade to the tune of hundreds of billions. Probably it would not surprise me if there are trillions of dollars essentially in that trade when you look at it on a notional basis. So when you think about the unwind, how many weeks, how many months could it take to unwind the yen carry trade, and how bad can it get? Well, it can get really bad, and this could last for a while. Our outlook has been more bearish, more pessimistic, and I mean, you'll get some bounces. Look, the largest bounces in history have always been in these deep bearish market environments, but generally speaking, those are opportunities to sell, not just buy in the initial chaos. Really, if you're looking for the bottom, it's not early as the cascade starts to happen. It's when things are just completely wiped out, what we call an exhaustion. And that takes time and it takes a lot of work through because there's a lot of supply, a lot of selling hitting the market, and we got to find new buyers, and buyers have stepped away. So it just takes time for all these things to work out. You'll get some big spikes, but for the bottom to be set, it might be a while. Let's look at some possible ideas here. So ABV, I mean, what a great looking chart in the midst of this market downturn. You've been in an uptrend. You had a recent breakout here on volume. You're pulling back, but even today's price action was fairly orderly, no massive volume. Do I think it'll back up a little further? Probably so, but as you get back to this breakout zone, it becomes interesting. Abbott Labs, similarly, we kind of broke out, we're pulling back. I suspect there's a little bit more selling that's likely to come, but as you dip into these areas, these would be the type of charts that I would be interested in. What has been safe? What has been acting well in a really bad tape? Now, on the bearish side of things, we got to think about things that have broken down. on volume. We've got to think about where there's potentially more pain to come. And I don't know what crypto's going to do, but I know that Coinbase is leveraged to that market. Now, one might argue, well, they make money off of transactions and more volatility is good for them. Yeah, that could be true, but I think the more there's volatility and the more that crypto doesn't hold up and it deteriorates this badly in a market sell off, kind of argues against crypto as an asset class. And the more people go away from crypto, that's a huge problem for coin. So I don't know how it's going to act exactly, but as you get these rallies up underneath 200, I'd expect it to roll over and I'd expect more selling pressure. Square is an interesting chart. You kind of have a little inverse cup and handle that just broke down. I'd anticipate more selling to come. And there's a lot of bearish charts out there. Look for things that are making new lows. Look for things that have just recently moved out of bases to the downside that look like they have more room to run. Big tech is likely to underperform while this market rotation is playing out. Are we headed towards the 200 period moving average? If you look at the S&P, we're a couple hundred points above it, and it seems like a magnetic pull. I could see the S&P moving down. The Nasdaq might take a little longer to get down to its 200-day, but moving towards that 200-day moving average on the S&P, another couple hundred points down, is kind of where I think we're headed in the shorter term. Could there be a Fed emergency rate cut? Again, I think there's a very good chance they were in discussions and in meetings today. Um, I would be, I would take it as a negative if they were to react to the markets. I mean, look, again, the markets are back to where we were a couple of months ago. The economy is not collapsing. If they step in and panic because of this market sell-off, we've got bigger problems within the Fed. That should not happen. It may happen, but it shouldn't happen, and we'll see. Airbnb, Amgen, Caterpillar, and Uber all reporting tomorrow, and we're still certainly in earnings season, so stay tuned for that. Hope you enjoyed today's market roundup. Stay safe out there. Again, what's important, rule number one, is survive every market environment. Do not let this be the hill you're willing to die on. It is not worth it. There is so much future ahead of you, so don't get caught in these unlimited risk propositions where you give back enormous amounts of gains and years worth of effort. It's just not worth it. Hope you enjoyed it. Have a great week, everyone. We'll see you next time.